Okay, so I think this Zoom is recording appropriately, so I'm going to try to discuss a little bit about my Facebook post yesterday on how to have your retirement accounts and your stocks and your portfolios work for you, and how you can capitalize in the short term to ultimately lower the risk of your investing. And I want to start from the beginning, and it can get a little confusing. So obviously feel free to post any questions you have or any things that need to be elaborated on. But I want to start from the very beginning so that we have a basic understanding of what we're dealing with here, so that as we move into some of the more complex, and I say complex, I don't actually mean it's complex, but there's a lot of verbiage that might seem confusing or a lot of concepts that you might not understand. So I'll try to draw some analogies, and then hopefully I can at least get the idea of how this concept works in reality, so that you can start to do your own research to start to think about exactly what it is we are looking for. So let me just make sure. Okay, so I think this is recording, but hopefully you guys can hear this, and I'm not doing this all for a waste. But let's start from the beginning, and that's owning stock. And owning stock gets tossed around. It seems a little scary. The thought that your money can, the value of your dollar of what you're investing in can go down over time is frightening. Granted, in this economy, you could have invested in just about anything and probably seen some sort of return. But what scares me is that people don't realize that without seeing profit in the short term, there's actually more risk than you would give credit to, in the sense that in 20 years, your stock might be up, but when you withdraw when you're in your 60s for your retirement, it might actually be half of what it was valued at a given point in your investment, right? So if we invested in McDonald's today for $100 and in 60 years it's $200, we've made 100% profit, which is great. But over those 40 years, we've had a significant amount of risk that we're holding by hanging on to simply a corporation without seeing any profit in the meantime. Now, there are dividends and there are other ways to make long-term profit. Typically, those are reinvested, so the money's still up in the air anyway. So there are two sides to this coin. It's one, gaining stock ownership, but it's also reducing your cost basis and seeing cash return in the interim, so that you have this one portfolio of cash that can be withdrawn at any time, and you have this other portfolio of stocks of which you've gathered over 30, 40 years, that you're starting to build a portfolio and have a low cost basis on, because a lot of times people feel like they missed the mark, it's not the right time. Well, this helps eliminate that fear and get you involved. And it doesn't take a whole bunch of money. Now, with that being said, there are opportunities to make significantly more capital with more capital. But of course, that's how capitalism works. Is the more capital you have, the more chances you have for your capital to make money. So I'll start speaking as if you have, we'll call it $1,000 in your account, $1,000 to invest in stock. And why invest in stock, and what is stock? So stock is essentially owning a piece of a company at a given value at a given time, with the hopes that when you eventually sell that company, the value of that stock has gone up, so that the value of your dollar has gone up. The concept is as simple as owning a house today for $100,000 and hoping that the real estate market goes up 50% in 10 years and you can sell that house for $150,000, right? It's essentially gambling your own security away, and it's risky. With that being said, it's necessary. If you're not investing in returns and gaining returns that are worth your time, it's not worth putting up the risk. If you're making 3% a year on your portfolio, it's better to put it in a CD. Without holding all of the risks. So without getting into that detail, so we understand the idea that buying let's call it one singular stock and one singular share of a company gives you a percent vested in that company that hopefully gains value over time. Okay, so we're going to use examples, real and also hypothetical, but it'll help gain concept. And I want to start by explaining not only does shares, which I think is a common understanding, or at least people understand the fact that you can buy shares of a company to own it in the hopes that that valuation increases, and that when you sell it, the value of your dollar's gone up. Okay, so we get that. People don't realize is the shares that you own, you can actually put up for capital to others to help make guaranteed income in the interim. And this is a concept that money makers, hedge funds, banks, this is what they do all the time so that they can constantly make money and then risk your capital that you're giving them to then hopefully make better returns or more monetary gain. But ultimately, it's what they're doing in these short-term blips of selling your shares up on the insurance markets. We're going to call it insurance. There are other terms for it, I'll get into detail. So what we're basically doing is needing to own shares of company A and then selling the right for someone else to buy our shares at a different price in future tense. Okay, so what does that mean? So we'll start at the basics, and these are options. Options get tossed around. There's a huge opportunity that if you buy option contracts, you can make thousands of % return, get rich quick. It's kind of that idea of glorified gambling on the Russian roulette table, hoping that you can put $5 down and make 3,200 on when it hits 33 black. Okay, great. But that's not how you're ever going to make money in the long term. And that's certainly not a stress-free environment. And no trading or no investing is stress-free, but it's far riskier. So how do we want to own stock, but how do we get that stock to have less weight of risk and also see return in the short term? And that's options. But the difference is, instead of buying options, we're actually going to sell contracts to the market for the right for other people to exercise the shares that we own at a given price. Let's go basic as possible. You own stock A, B, C at $10 a share. The date is December 31st. You go into the market and you sell someone the right to buy your 100 shares at $10. So you're $1,000 invested, for the right for someone to buy those shares at $11 at the end of next month. Now, this is very basic, and this isn't exactly, there's Greeks involved, there's some time value of money that gets confusing, but at the end of the day, you need to understand a concept, because the verbiage doesn't really matter here. I'll get into some specifics, but so we understand the concept that I own 100 shares at $10, and I'm going to sell the right for you to buy those 100 shares that I own at $11 next month. People are betting that the stock that I own won't be trading at $11, but it might be trading at $50 or $15, and they get to buy my shares at $11. You would say, well, why would you do that? Doesn't make any sense. Wouldn't you want to just sell them at $50 yourself? Sure, you would, right? Ideally, you would want to sell them at $50 yourself. That's if you can see the future. And in the end of the day, no one knows what's happening in the future. So it's about, what can I do to minimize my risk in the meantime and try to work my shares up to being eventually $50. And that's by selling these contracts to other people in the market for guaranteed return. So let's look at this. If I have 100 shares at $10 a share, and I sell you the right to buy those shares at $11 next month, I'm going to charge you a premium on those 100 shares today so that you can exercise it at $11. And why would anyone pay that? Well, they're paying it because in 1 month, that individual who's buying it, you're buying it, you think that stock's gonna be trading at 15, so you're actually getting a discount, and I'm receiving a guaranteed capital up front plus selling my shares for $1 gain. So there are a couple different things that can happen out of this. Right off the bat, you're gonna give me, let's say, $1 per share. Every option contract is in 100 shares. So we need to understand that when I say one contract, it means 100 shares. And when the premium price attached to those 100 shares are done in 1 share increments. So 100 shares, if I'm selling you this contract for $1, you're going to give me $100, $1 per share, for the right to buy those shares at $11 next month. Gets a little confusing, it gets a little tongue-tied, but we need to understand the concept here and how this works. And I'll go into a different example. So you give me $100. I write a pretend contract that is exercisable, and I have to sell you my shares at $11 if you choose to exercise it by the end of next month. So I make $100. I'm $1,000 invested in stock ABC, right? $1,000, but I just made 100, which means my total vested dollars that I'm in stock ABC is actually 900. So what I've done is I've seen cash on this side, and I'm still $1,000 vested on this side. So I get the cash, I get the credit in my account, and I also still own the 100 shares. So fast forward, what happens if in 1 month, the stock ABC is trading below $11 a share? Doesn't matter where it is trading below, right? It could be trading at 1050, could be trading at 950, could be trading at 850. Stock ABC is not trading over $11. Well, you would not exercise that contract. You would rather just say, you know what, keep the $100 that I gave you. I don't want these shares anymore, or I'm just going to go into the market and I'm going to buy them at 850 myself because it's not worth it for me to spend $11 a share. Great, we're happy, and this is an okay thing that we want to happen in the long run. And frankly, we want it to happen more often than not because we want to collect a premium. So we make $100 and we still own our 100 shares. We're done. End of the month, it's over. So now we look into February and we're like, okay, end of February. Stock's trading at 1050. Well, maybe instead of selling another $11 contract, we want to sell a $12 contract. And we sell the $12 contract for whatever that premium is paying at the beginning of January. And let's say it's paying $2 because the stock has been volatile. It's supposed to move, earnings are coming up, whatever might be in the future. So we're selling you that right to buy my 100 shares now at $12. So if at the end of February, my 100 shares are over $12, you get to execute them at 12 and I make 11, 12, I make $2 per share that I own because I'm selling 100. And I also collect $200 on the premium because that's what I sold you the contract for. And if we look at this from a percent gain over time, again, let's play it back. It's not $12 at the end of the month. Let's say it's lower. Let's say it's $9. The shares are now $9. So my shares are technically down $1, except I've collected another $200 premium. I originally spent $10,000 or $1,000 on these 100 shares. I've now collected $300 in 2 months and gotten my total vested amount is now $700. And you can start to see where this process works for you, right? The more times that you're selling premiums and you get to keep the shares, the more likely that the value of your shares are getting closer and closer to net zero. And then the goal is to make that a net negative so that you're actually profiting off of the shares that you own and your total vested is $0. So when we look at accounts that for the long haul, people are riding waves, they're up 300%, they're down 50%. They go through all of these, roller coaster rides, but no one's ever collecting any profit in the interim. What selling calls gives you an option to do is sell the right for you to sell those shares at a profit. So you always want to set your premium above what your average share cost is, because if it does exercise, you want to make money on the shares, but you also want to collect premium in the interim. So there's 2 ways that you're making money. And let's think about this as a different example. You're in the housing market, you own a house today, and you go to your neighbor and you think, we got to change the presidency. People are buying houses. People are getting back to work after coronavirus. I think the housing market is going to go up next year, right? I think next year we're going to see a 15% increase in housing. So you go to your neighbor and you say, hey neighbor, heard you were thinking about moving. I will give you $5,000 today for the right to buy your house that is only valued at $100,000 today, for the right to buy your house at $110,000 at the end of next year. And your neighbor goes, all right, I make $5,000 today. And if my house, and I get a guaranteed sell price on my house for next year, if Connor chooses to buy my house, I know I'm going to get $110,000. I don't have to negotiate. I don't have to do any of that. Your neighbor goes, okay. You go, okay, all right, I'll take the $5,000 today, and then an extra $10,000 next year for the right to buy my house at $110,000. I don't really care what the stock is or what the house is. Let's say it's valued at $200,000. I lost out on making $90,000, but I still made a 15% return on my house. It's a great way to look at it, right? And let's say the housing market's down next year. I made $5,000 on the underlying value of a $100,000 house, and now my neighbor is no longer interested in buying my house. So I just made $5,000. Okay, great. We're collecting cash in the interim to reduce risk. It's the same thing with options, and options that were created so that extremely wealthy people could stay extremely wealthy. Now, there are other factors to think about in options. We can get into volatility, time value of money, time decay. There's other things that can affect what this, what would end up happening. But you have to start to think about this from a pragmatic standpoint. And it's the fact that you don't know what's going to happen in the future, right? And if you don't know what's going to happen in the future, you need to protect yourself in the short term. And protecting yourself is, if anything, you're actually reducing your risk, because you're collecting and seeing a percentage return gain in every single month. That ultimately reduces risk. And the whole goal here is to have your money working for itself. And this is just one of the most common ways to do it without, needing to know a ton of, I mean, yeah, we can get into derivative trading. We can get into all of this crazy formulas you can do and help increase your risk and spreads and condors and all this other madness with options. But at the end of the day, if you are invested in the stock market and you have shares and your shares are up or your shares are stagnant, what can you do in the meantime to start having fractional percentage gain in your account every month to compound those gains into yearly returns? And so I'm going to share my screen, and hopefully this recording you can see it. And I did this model with Tesla, and this is a perfect model, but I'll kind of go over what this would look like to someone who had invested in Tesla at the end or at the beginning of this week and did this for 52 weeks. So Tesla has options every single week. You could technically exercise an option every week. What you're looking for is the sweet spot on where along the time am I getting the highest premium for the highest potential price. So on Monday, hypothetically, I bought 100 shares of Tesla for $631 a piece. I'm $63,100 invested in Tesla. That's a risky trade to be in, especially if you have only $63,000 in your retirement. So I wouldn't suggest anyone going to do this. I'm just trying to show you what the value is. So I'm invested $631,000. You can see total cost of underlying shares. Now this premium call price, these premiums on Tesla are super volatile. So they're selling for a very high dollar. This contract was for January 8th. So I didn't write the date down. That was stupid. But so that's a 2-week call. So I'm selling the right for someone in 2 weeks to buy my shares that I bought at $631 at $675. They're paying $2,000, right? $20.50 per share times 100 for the right to buy my Tesla shares at $675. Why would anyone do this? Well, Tesla's volatile and it might be trading at $800. So they want to get a discount on Tesla. They're risking the $2,000. Those are your giant hedge funds. Those are, some YOLOers who want to just make millions, right? But we're okay with that. We sell $2,000 and let's say Tesla doesn't reach $675. We collect $2,050 from this profit from this premium and we still own the shares, right? So immediately we're making, $2,000 divided by $60, we're making 1.8% or whatever return that is, the 3.8% return in 2 weeks on our capital in Tesla. And if the call does exercise, we're making $2,000 plus the $40 per share difference that we're selling for $6,450 in gains in 2 weeks. And we really don't want this to happen. We would rather keep it, but still we're getting a 10% return in 2 weeks. So we're still happy with that. Let's say for a full year, we sell premiums in Tesla and continue to own the underlying share. And we make an average of $2,000 per premium. We're making $49,000 in 1 year of owning Tesla. 24 weeks in 24 2-week periods. We're making $20,000 or $2,000 per 2 weeks. We've now cashed in $49,200 in 1 year of owning Tesla shares while still owning the underlying share. And you can look at this 2 ways. I now have cash to put aside to grow your retirement, or the shares of my Tesla now actually cost $139. So there are 2 different ways you can look at this. This is the basis that we've brought our Tesla price down. I mean, we've made a return of 85% in a single year while still owning the shares of Tesla. And without getting into, I kind of want to end the video. This has been long, but if you do sell your shares, there are ways, every piece of the market has an opposite side. So we're selling the calls. You can also sell puts for the right to buy stock at a lower price. So if you do exercise at $675, let's say you sold these and you want to get back in Tesla, all you do, instead of selling a call for the right to sell 100 shares, you sell a put for the right to buy 100 shares at a lower price. So let's say we sell a put at $600 and the price is $675, we're collecting probably about $1,000 premium every 2 weeks until those shares are under $600, which we're okay with getting back in Tesla at under 600. we're profiting $1,000 every 2 weeks. We don't own the Tesla shares anymore, but now we're making profit off of the premium for the right to buy those shares, which we want anyway. So there are two sides to look at this. This is continual profit. This is compounding interest, and just something to open your eyes on the opportunity that is out there by putting the shares that you own today to work. So, diversify, take a fraction of your portfolio and practice selling covered calls, be strategic, be methodical. And then eventually you'll start to see, and don't look at it from a dollar amount, right? Look at it from a percentage amount. So you have $700 and you sell a call and you make $70 in a 1 month period. Don't be like, oh my God, I made $70. That's not worth it. No, you made 10% in 1 month. Do that again next month, you make 10%. Do that again next month, you make 10%. Now your portfolio, after a given year, instead of being worth 700, is now added 120% return. So be patient, do it for the long haul, start today. If you have any questions or, you want me to do a more, I can definitely make this video more serious and do some slides and walk through things at a slower pace. But this is just kind of the idea of what it is like to put your shares to work for you so that you aren't in a business of high risk investing. You're not risking all your capital and you're ultimately guaranteeing yourself profit on shares that you already own or want to be vested in. So anyway, hopefully the sound worked and hopefully the screen recording worked. But yeah, peace out.